Hello everyone, welcome to our channel India Equity Investing. Today we are going to analyze Shree Pushkar Chemicals and Fertilizers Limited. This is the chronological order in which we are going to review the company. So I've tried to keep it, quite detailed but also concise at the same time so that we are able to understand the company better over the next few minutes. In the first two slides, we will look at the company's background and its evolution. Then we will understand the company structure and review the standalone business and the company's two subsidiaries. Then we will look at its product portfolio. And lastly, we will look at the company's financial model, followed by company's current valuations. The company started its operations in 93 as an importer of chemical products and dye intermediates. And then it shifted its focus from trading to manufacturing in 2001 when it set up its first single product uh, manufacturing plant within the dye intermediates. And after that, over the next few years, the company focused on backward integration. And if we fast forward to today, the company operates eight manufacturing plants that produce over 25 products across dye stuff, dye intermediates, fertilizers, and animal nutrition segments. It has become a vertically integrated organization that is recognized as a zero waste company. So, this is where the company started as a dye intermediate trader and then a manufacturer. Then it focused on its backward integration. And then in the last few years, the company focused on dyestuff manufacturing as well. This time chart shows company's trajectory over the past 3 decades. The key highlights here will be, setting up plant in 2001, the dye intermediate plant, followed by setting up acid complex in 2010, and then setting up SSP manufacturing unit in 2011. After that, the company got listed in 2015 and, started dye stuff manufacturing in 2016. After that, the company made its first acquisition, that of a fertilizer company by the name of Kisan Phosphates in 2017, followed by another acquisition in the fertilizer space, that of Madhya Bharat Phosphate Private Limited in 2020. So the company operates through three key entities that form part of its overall operations. These are the standalone business that the company has grown organically over the past 3 decades, and then the two key acquisitions which have now become 100% subsidiaries. And we'll be analyzing each of them in detail. The company's standalone business, informally called as Pushkar, contributes around 60% to the total revenue of the company. This standalone business basically comprises of chemicals, fertilizers, and animal feed manufacturing. Now, the chemical business of the entire organization is basically, within the standalone business, and it comprises of dye stuff, dye intermediates, and acids. The company currently has five manufacturing plants within the standalone business, and combined they have a fertilizer capacity of 150,000 metric tons per annum, which includes 50,000 tons for sulfate of potash and NPK and a few other fertilizers, and 100,000 metric tons for SSP. And then the company has around 21 or 1,000 metric tons of annual capacity for chemicals manufacturing. This includes 6,000 tons of dye stuff and 15 or 1,000 tons of dye intermediate. Over the past few years, the company has spent around 120 crores in setting up Unit 5, and this is basically funded through internal accruals. And the company has started its commercial production and as well as its trials by the end of FY23, and once fully operational, Unit 5 is likely to contribute somewhere between 200 to 250 crores to the total turnover of the company. And Unit 5 basically is going to generate 70% of revenue from chemicals and remaining 30% from fertilizers manufacturing. Within Unit 5, there are three plants. One is a sulfur chemistry plant, then an acid plant, and finally the dye intermediate plant. Looking at the financials of the standalone business over here, the revenue has, barely grown 10% over the last 5 years. from 370 odd crores in FY18 to 420 crores in FY23, and PAT margin has declined significantly from 9 odd percent to 3.5%. This decline in PAT is basically coming from the severe pressure that the company is witnessing in the chemicals business. The dye intermediates pricing has suffered a lot. There is, very little demand for dye stuff as well, since the textile industry is suffering. And that's the reason why, while the fertilizer business did try to make up for, the loss in the chemical business, uh, and the overall margin hence came to around 3.3%. And if we once the chemical business turns around, we can expect the profit margin to go up. If you look at it, the revenue coming from chemical sales, so this revenue has marginally declined over the past 5 years. And the reason for that is, if you look at the period of around FY18 and 19, at this time the realization of dye intermediates was very, very high, which resulted in inflated realization. And that realization, the price per ton came down over the next few years, due to which there was decline in the overall chemical sales business. The company acquired Kisan Phosphates, which is a SSP fertilizer and animal nutrition manufacturing company, for rupees 9 crores in 2017. The rationale for acquiring this company was that it provided Shree Pushkar a foothold in the key North Indian markets of Punjab and Haryana. And the company has turned around over the past few years after the company went for backward integration by setting up a sulfuric acid and captive power plant. So the company's sales have increased from 46 crores in FY18 to around 132 crores as of today. So it's close to 3x over the past 5 years. And the PAT margin is also reasonable at around 8 odd percent. And the company has recently done some additional capacity expansion by increasing the fertilizer capacity from 100,000 tons to 132,000 tons per annum. And this is likely to contribute to further growth and revenue from this business in the next year. Madhya Bharat Phosphates is another key acquisition that the company did in 2020 for rupees 28 crores. So, as part of the acquisition, the company got two plants for SSP manufacturing, one at Meghnagar and second one at Diwanganj. And it also got a non-core asset, which was a land parcel at Mandori, which the company intends to sell off at some point in time. Um, the company made operational the capacity of around 100,000 metric tons across these two lines, and at that time it had revenue potential of around 100 odd crores. And after that, the company, when it started operations, it got good response from Meghnagar plant, and then later it decided to operationalize the Diwanganj plant as well, which the company had in earlier thought of selling off. And the company also realized at that point in time that Madhya Pradesh is the highest consumption state for SSP in whole of India, and hence it provides a good opportunity for the company to grow. And the acquisition again is very far away from the current plants that the company has. So it's again a new market that the company will be targeting. And using Madhya Bharat Phosphates, the company today targets Madhya Pradesh, Chhattisgarh, and part of Rajasthan as the key markets for fertilizer supply. So for FY23, Madhya Bharat Phosphates did revenue of 133 crores, which is similar to that of Kisan Phosphates, and contributed around 19% to the total revenue. This revenue mainly came from sale of SSP from its Meghnagar plant. So the Diwanganj plant, currently has a production capacity of 100,000 odd metric tons, and it has commenced trials as well as commercial production, and it is likely to contribute to the revenue of the company from third quarter of FY24 onwards. So bringing, the Vanganj plant to the current stage of production has been quite challenging for the company. First it was facing issues in getting the access road. Once it got the access road, Then it realized that it did not have the permission, or in other words, the permission was cancelled by the pollution control board. So then it took them time to get the permission from the control board, and then currently they are stabilizing the plant and looking to ramp up the production over the next couple of quarters. In terms of margin profile, the business at Madhya Bharat Phosphates is likely to be similar to that of Kisan Phosphates, where the company, for fertilizer business on a normalized basis expects to, generate a PAT margin of around 9 to 10%. And I think we can expect the company to generate that kind of margin in the next, 1 to 2 years as well, once the business stabilizes further. Here is the summary of all the plants that the company has as of today. So there are five fertilizer as well as chemical manufacturing plants in Pushkar. Then there is a solar power plant as well in the standalone entity, Pushkar, that caters to Unit 1 and Unit 5. This solar plant is expected to you know uh, contribute around 5 to 6 crores to the EBITDA of the company in a normal year, after offsetting the electricity expenses. Then we have the Kisan Phosphates plant in Hisar, Haryana, and then two plants in Madhya Bharat. One is the Diwanganj plant, and second is the Jhabua plant as well, which we also call as a Meghnagar plant. So overall, the company currently, where it stands as of now, it has the capacity to generate a revenue of around 1,000 crores in total, subject to normal market conditions. So this is likely to, come in the form of 6 to 700 crores from the, standalone business, with Unit 5 starting to contribute around 200 odd crores in the revenue. Then there is around 150 odd crore of revenue potential from Kisan Phosphates Limited after the recent expansion, and of around 200 crores from Madhya Bharat Phosphates Limited, specifically now since the Vanganj plant has also been made operational. So here we can look at the overall product portfolio of the company, and we will analyze the key products that the company manufactures, starting with dye intermediates, followed by dye stuff, fertilizers, and then animal health and nutrition. So now the question comes as to why did the company start with dye intermediates? The company is based out of Maharashtra, which alongside Gujarat has a strong presence of the textiles industry, which is due to easy availability of raw material for the textiles industry. And a textile industry requires dye stuff, for which dye intermediates are a key raw material. And this dye intermediate is the raw material which is required for manufacturing dye stuff, which is then used in the textile industry. And this is where the company saw the opportunity and started by importing dye intermediates such as H acid in 1993. And that is where it all started for the company. So let us now understand what are dye intermediates. So these are basically, petroleum downstream products that are used as raw material for, manufacturing of acid, reactive, and direct dyes. Now let us look at the typical manufacturing process for dye intermediates. Catalytic reforming of naphtha in high pressure reactors produces benzene, toluene, and xylene, which we also call as BTX in short form. Now, benzene and toluene produce nitroaromatics by the process of nitration using sulfuric acid. These nitroaromatics are further used in making compounds called dye intermediates. Overall, if we look at it today, the company manufactures, five key dye intermediates. These are H acid, vinyl sulfone, sulfur parabase, K acid, and gamma acid. Dye intermediates manufactured by the company are mainly used for manufacturing in-house dye stuff that is sold to the textile industry. And whatever dye intermediates are left after that is basically that inventory is sold in the open market mainly to the domestic customers. The company currently has capacity to produce around 15,000 metric tons of dye intermediates per annum, and this capacity is likely to reach 38,000 metric tons in total once the contribution from Unit 5 starts to kick in. Overall, dye intermediates contributed around 194 crores to the company's total revenue in FY23, which is a little under 30% of the total revenue. Entry into the dye stuff is now a natural progression for the company in the form of forward integration, because this allows the company to get greater realization and also get a low cost advantage at the same time, which means for selling at the same price in the open market, the company will generate a relatively greater profit. In the last 1 year, there has been significant pressure in terms of the costing of dye intermediates, which has increased due to higher raw material costs. And at the same time, the demand for dye intermediates has come down. So due to this, lot of, independent dye intermediate manufacturers who are not well vertically integrated have actually shut shop and are not manufacturing dye intermediates as of now due to the poor business environment as of now. Dye stuff is basically a soluble substance such as pigment or dye that is used for coloring various materials. It is also called as a reactive dye because this is the only type of dye that reacts chemically with materials and eventually becomes part of that product. Dye stuff that is manufactured by our company Shree Pushkar is basically targeted towards the textile industry. Overall, if we see, dye stuffs can be used in multiple industries like food products, leather, paper, plastics, printing inks, and textiles. But we will focus primarily on the textile segment because that is the one that Shree Pushkar is catering. Global textile dye market is estimated to be anywhere between 8 to 10 billion dollars. And India's exports during last year were around 2.5 billion dollars, which was around 20% decline on an annual basis. And the reason for that is basically there is a oversupply of dye stuff in the market as of now. There is a general downturn in the textile sector, which has created a demand supply gap. And overall, if you look at it, what is happening is that now the dye stuff manufacturing is shifting to low cost countries like India, and that is one place where the company sees the opportunity to grow. Dyestuff is among the highest chemical export segments in India, with over 1,000 SMEs and around 50 large organizations engaged in its production. So SMEs account for roughly one third of the total dyestuff production in India. The company started dyestuff manufacturing in 2016, and it currently has an installed capacity of around 6,000 metric tons per annum. And around 60% of the dyestuff that is manufactured by the company is sold under its brand name Dicol, while the remaining 40% is being exported to global MNCs. Overall, the company exports 90% of the dyestuff it manufactures, and it is basically sold to markets like Bangladesh, Europe, and in recent times to Turkey as well. The company says that Dicol uses less water, energy, and processing skills in comparison to conventional dyes, due to which Dicol becomes more sustainable and environment friendly. Now this is very important because the buyers today look at environmental friendliness and sustainability as the key aspects for the suppliers of Dicol, and this just brings an additional advantage for the company, although this remains overall a highly commoditized industry. Here we look at the revenue performance of the chemical business over the past few years. So in 2018, the company did chemical sales of around 300 odd crores, which last year was lower at 297 crores. So over the past 5 years, the company has seen a marginal decline in chemical sales. And but at the same time, the company has expanded rapidly in the fertilizer business, due to which if we see the sale contribution from chemical business has come down from 76% in FY18 to around 43% in FY23. And this will go down further as the capacity expansion in the fertilizer business converts into the actual production. Now let us look at the fertilizer business. The company today is among the top 5 SSP manufacturers in India with the total capacity of around 590,000 metric tons per annum. SSP and other such fertilizers generally cater to the regional demand. And for example, Shree Pushkar sells SSP and other such fertilizers of various grades within the vicinity of 300 kilometers surrounding the plant. Now, if you look at all the plants of the company, so four plants as such, assuming Pushkar as the standalone business as a single unit. So that basically, caters to the Maharashtra market and Gujarat market. And then you look at Kisan Phosphates, which basically is based in North in Haryana and caters to, UP, Punjab, Haryana markets. And then you have Madhya Bharat Phosphates based out of MP that caters to MP plus Chhattisgarh plus part of the Rajasthan market. So all of them cater to the regional markets. And, currently, if we look at it, the company also has a 50,000 ton capacity for a few other fertilizers as well. So here is the split for the same. In terms of the overall fertilizer market in India, India is the second largest consumer of fertilizers as of today. Since it has around 195 million hectares of area under field crop. And at the same time, the country is also the third largest producer of chemicals. And urea, NPK, DAP, SSP, MOP are among the key crop fertilizers in India as of today. SSP, which is single super phosphate, is basically a relatively low cost fertilizer that is popularly termed as a poor farmer's fertilizer. And the government is encouraging SSP production since it is indigenous and is considered as an alternate to diammonium phosphate, which is imported and quite costly. The government has also recently set up a task force under Fertilizer Association of India to find ways to improve the quality of SSP and also promote its use. Total fertilizer consumption in India during last year was around 63 million tons. And out of this 63 million tons, if we look at it, 34 odd million tons is basically urea, and then there is a number of other fertilizers, primarily NPK, followed by DAP, SSP, and MOP. Now what the government is trying to do is basically substitute DAP with SSP. And the interesting part over here is that for every ton of DAP that needs to be substituted, you need to produce or consume 3 tons of SSP. And we'll talk about it. And overall, if you look at the fertilizer market in India, it remains highly fragmented, with top 5 companies having around 35% of market share. Now, single superphosphate basically has three major nutrients. These are phosphorus to the tune of around 16%, calcium anywhere between 19 to 21%, and sulfur anywhere between 11 to 12%. Other optional micronutrients can be zinc and boron. Now, after independence during 1950s and 60s, farmers used SSP to meet phosphorus requirement. But with advancement of agricultural practices and greater requirement of phosphate over time, the use of SSP went down and was substituted by use of diammonium phosphate, which is DAP, monoammonium phosphate, MAP, and NPK. Specifically, its segment, which is or a gradient, which is called as 12:32:16, which is basically a composition of NPK. What led to the decline of SSP besides its poor quality was that, due to lesser presence of phosphate in SSP, the farmer had to use 2 or 3 times more bags of SSP to make up or equate to the DAP. And then it also involved more labor and transportation costs, due to which, the farmer preferred moving to DAP itself. And SSP also developed bad reputation due to quality concerns, because of which the farmers actually lost trust in the product. Now, what the government has also done in order to ensure that the quality of SSP is maintained is that they have made it mandatory for a single SSP unit to have minimum capacity of 1 lakh metric tons. What has happened in the past few years is that the cost of phosphorus has become quite expensive and it has to be imported, which has resulted in higher prices of DAP. Overall, if we see, DAP remains the most widely used fertilizer in the world with a global annual consumption of around 30 million tons. That is followed by NPK, which has a global consumption of around 20 million tons. SSP consumption in India, as we have seen, is around 5 million tons. And the government would like to double it over the next few years by switching it instead of DAP. One point to note is that for SSP production, rock phosphate is required. Now, rock phosphate is available in India, but at the same time, it is also imported from various countries. Shree Pushkar primarily imports rock phosphate that it uses for manufacturing SSP. The government is also providing some freight subsidy on the road transport of SSP above 200 kilometers and going up to 500 kilometers. And the subsidy also ranges from 300 rupees to 500 rupees per metric ton. Now, please note that there is a nutrient-based subsidy NBS policy that is issued by the government to allocate subsidy based on the nutrients in a product. This subsidy is given on a per nutrient basis. So, according to the total nutrients held by SSP, it results in subsidy of rupees 7,513 per ton as of today. So what the NBS basically does is that it promotes balanced use of fertilizers with greater use of other nutrients like phosphorus or potassium, and it promotes domestic fertilizer industry. And one of the key objectives for bringing in this policy was to wean farmers away from excessive use of urea. The table below shows the nutrient-based subsidies specified by the government on over the past decade. It allows fertilizer manufacturers to fix prices of NPKs nutrients based fertilizers at reasonable levels. Now, giving of subsidy is quite a interesting process, and I like to just briefly touch base on that as well. Now, this subsidy is not given directly to the farmer but to the manufacturer for the products sold via point of sale. So, whenever a product is sold to the farmer, he has to put his thumb impression, which is linked to his Aadhaar card or Kisan credit card, and eventually to his land records. Now, then the subsidy is authorized, and based on the material sold by the PO on the POS, the manufacturer becomes eligible for the subsidy on first come first serve basis. So the entire system of giving subsidies is digitized, and as of December 22, there were around 2.6 lakh point of sale terminals for capturing the subsidy data. Now, this slide shows the subsidy by fertilizer that has been given by the government over the past decade or so. So if you look at it, as of today, the DAP subsidy for for Rabi crop till March 31st, 23 was around 48,000 rupees per ton. For SSP, it's around 7,513 rupees per ton. It has remained flat over the past 2 years. And similarly, we can see the the subsidy by various fertilizer grades. So here, what this basically means is that we have the fertilizer name, and then we have the composition, the percentage composition that it has of various nutrients into it. So let's look at the fertilizer business performance. As of today, the company has capacity of around 590 1,000 metric tons per annum of fertilizer production, which is primarily SSP. And it will allow the company to manufacture around 450,000 metric tons of fertilizer. So the capacity utilization can never be close to 100%. it will be somewhere around 75 or percent. That would allow the company to meet environmental norms as well, and so let's look at it that assuming the average fertilizer price of around 15 to 16,000 rupees per ton, we can expect the company to generate a fertilizer revenue in the range of 600 to 700 crores per annum. So we can assume this until as the fertilizer prices crash and the number hence comes down. So excluding that scenario, 600 to 700 crores of revenue is what we can expect from 450 or 1000 metric tons of fertilizer production in a year. And the company believes that on this revenue base, the company can generate a EBITDA in the range of 18 plus percent. That will give it a PAT margin of around 9 to 10%. And if we look at it over the past few years, the fertilizer sales have increased from 70 crores in FY18 to 300 plus crores in FY23, with the current contribution of fertilizer sales at around 49% of the total company sales. Now we briefly touch base on the animal feed business. So, animal feed manufactured by the company is basically used as an additive for the feed given primarily to the cattle and poultry birds to meet their, phosphorus and calcium requirements. So, what the company does is that it gets, substandard acidic effluents, and then it gets wastewater from its, production of various chemicals and fertilizers, and production of animal feed can be done using those effluents. And that is how the company is reducing its the effluent discharge. And in summary, during FY23, the company did around 11,000 metric tons of animal nutrition sales at an average price of around 40 to 42,000 rupees per ton, which translates into a revenue of around 45 odd crores per annum. This flowchart basically shows the flow of various materials in the production process at Shree Pushkar that minimizes the effluent generation and also at the same time results in value creation through both backward as well as forward integration. Now let us review the P&L statement of the company. For the year ending FY23, the company did a revenue of around 684 odd crores. Now, this was basically a growth of around 17% over the preceding year. But, before start of FY23, the company was expecting, that it would hit a revenue base of around 800 plus crores, somewhere between 800 to 900 crores. Anyways, due to decline in the chemical business and some pressure on the fertilizer business as well, the company attained lower than the expected number. And at the same time, if you look at the gross profit margins, they declined marginally uh, by around 170 odd bips to come in at 253 odd crores, resulting in the EBITDA of around 10%, which again is lower than what the company has done historically. And and eventually, if you look at it, the PAT was at around 5.4%, which is probably the lowest that the company has done in the past many years. Now, in terms of the outlook, we expect the company to grow at the rate of 20% during next year and hit a revenue of around 1,000 crores over the next 3 years. And at the same time, we expect the company to show higher gross profit as well as EBITDA margin. We do believe that the company will generate, more than 13% EBITDA margin over the next 2 to 3 years. Since it's a commoditized industry, it's quite difficult to predict what the costs and would be like because of the demand supply dynamics. But we do expect that given its vertical integration, the company is better placed to do well, and we expect the cycle to turn possibly at some point in time over the next 2 or 3 years, which should result in higher than projected EBITDA margins. And overall, we expect the company to double its PAT over the next 3 years. And hence its EPS should grow from a little under 12 to around 25 plus over the next 3 years. Here we look at the cost structure of the company, and I think already a lot of the points have been discussed here. Due to setup of the power plant, solar power plant, we believe that this cost would to an extent go away and would trickle down into the EBITDA margins that we have not built in. And after that, I think something that we like about the company is the good return on capital that the company has. It has historically generated good ROEs, and we expect that over the next couple of years, with no capex plans in sight as of now, the company is likely to generate close to 20% ROEs in this business, and the business is likely to throw a lot of cash as well over the next couple of years. Now, looking at the balance sheet of the company overall, if we see the current scenario in terms of where we are and we where we expect to be, we see 270 odd crore increase in the asset base. Now, out of this, we are seeing that 200 odd crore is basically the cash that is coming into the books. There is a marginal increase in the working capital, and then we see that there is some increase in coming in terms of the gross assets, which is again bare minimal. We have not built in any new capex that company has not disclosed till now. So overall, I think where we are, the company already has set up good capacity, has done a lot of capex in the past, and now is the time to consolidate the operations and generate cash. And that is what we expect the company to do over the next 2 to 3 years. Now, looking at the key balance sheet ratios, overall we expect the net working capital days to largely remain consistent. And the asset turns is something that we expect will go up from, the fixed asset turns will increase from 1.1x to 1.8x, and this will result in better cash generation for the company. We have not built in significant capital expenditure and have kept it lower as of now, and increasing it only around FY26, when we believe the company will again start spending in terms of new plants and things like that. Overall, we expect the company to run a tight ship, and I think one key point that we should note about the company is that it has a policy to ensure that it does not build a lot of inventory. It ensures that the throughput is good and the cash comes into the business. So I think that allows the company to maintain a good fiscal position, and the company is as of today absolutely debt free, and we expect it to prioritize cash generation as again and again indicated by the company as well over the next few years. So, over the next 3 years, we expect the company to generate a cumulative cash of around 200 plus crores, net of fixed asset investments, which translates roughly into an annual cash generation of around 70 crores. And let's look at that while keeping in sight the current shareholder funds or the book value of around 437 crores as such. So I think that shows the kind of cash generation the company will do over the next 3 years. Please note that we have not assumed any dividend payout in our model and assumed that cash stays on book. Eventually, in our ROI analysis, it will, not make much of a difference whether we take dividend payout or we take the, income on the interest basis. As of today, that is 4th of June 23, the company is trading at around 17 times its trailing earnings. So this translates into a market cap of around 627 odd crores. And given the good cash generation by the company, 20 odd percent plus ROEs and no major capex in sight, we believe that it would be fair to assume that the company will trade at its historical, trading multiples of around 14 times trailing earnings, and which would also translate into a price to book of around 1.8 times, which is, I think, kind of a fair number for this business. In terms of comparables as well, the comparables do trade at around these multiples. So I think kind of a fair estimate if you look at it. And assuming 13 to 14 times trailing multiple exit, we expect the company to generate a IRR of around 19 to 22%, assuming a 3-year investment horizon as of today. So, we got into this business at the price of around 165 rupees per share, and in case the stock falls further, we will be very keen to build onto our positions. At current valuations, we would not be interested, but we hope that that the stock price falls over the next few months so that we can increase our holding in this company. This is a commoditized business that we do not generally invest in, but I think we do see value over here, and it would be interesting to see how it pans out going forward. Here we look at the trailing 12-month P/E multiple chart of the company over the past 6 to 7 years, and the company has traded at high P/E multiples in the past when so these are the times when the multiples were good, the earnings were good, and it did hit a lower P/E of around close to 6 times, and it has over the last year and a half traded in the range of 12 to 14 times, and we expect our exit at similar multiples in the future as well. So no kicker coming in from multiple expansion. So a few observations about the management as well. We've found the management to be very forthcoming, honest, and passionate about the business. It is very ambitious, and at the same time, it acts in a very cautious manner, while keeping the long-term prospects of the business in mind. It does not care about the quarterly performance as much as about the long-term prospects, which I think is a good sign again. And again, as indicated in the past by us as well, um, there is a strong focus on cash flow generation, which means that the company is willing to compromise on profitability in order to ensure that the clients are well looked after and the inventory keeps on moving and during the poor business environment. And in the current phase as well, the the management is now focused purely on consolidating the business, and it is conducting repairs and maintenance of the existing plants wherever required, to ensure that when the environment turns favorable, it is able to capitalize on that favorable environment. So overall, no red flags in terms of the management. With this, we end our analysis of Shree Pushkar. I hope you found it to be informative. We look forward to sharing more of our research ideas with you in coming weeks. Thank you for your time once again.